IAS 33 looks at earnings per share. It's a key metric used by investors, and it really just describes the profit for every share that is held by an investor. They will use that to compare it to other entities or to compare it to the dividend that they get per share to see how much money is being kept in the business versus how much is being transferred to them as one of the owners. Now, the profit figure is just the profit attributable to the parent shareholders, knocking out any non-controlling interests. And the number of shares is the weighted average number of shares, and that takes into account any time apportionment of any share issue during the year to reflect the fact that if you've issued shares halfway through the year, the business has really only had that cash for half a year to turn it into profit. There are other considerations with rights issues and bonus issues that are included in the standard as well. And it's all to reflect when did the cash come in and how much chance has a business had to turn that into profit. Alongside earnings per share, there's an element called diluted earnings per share. Now, diluted earnings per share really acts as a warning to shareholders. It takes the current earnings per share figure and says, well, how will this fall based on things that are already in existence? And they are commonly either a convertible loan or options. Now, if a business has options that it's granted to its staff, or if it has a loan that a holder can convert into shares, what will happen is, in the future, that weighted average number of shares calculation could dramatically increase. And so they present a diluted earnings per share calculation next to EPS to show, here's your current earnings per share of, say, 20 cents per share, but then the diluted earnings per share may be 17 cents. And that can really show the shareholders the impact of those convertible loans. And they can use that information to decide, was issuing a convertible in our interests? Would it have been better to just take a loan, maybe with a higher interest rate, but it didn't dilute my own ownership and didn't give me less of a return in the business? That would be the same with share options, where actually shareholders can decide, was giving this many options to the board worth it if it's going to reduce my earnings by this significant amount?